Hello, everyone. Welcome to another episode of Flipping Out. This is Paul Lizell, your host, and today I have with me Michael Poggi. Is that right? Is it Poggi or Poggi? How you pronounce it?
G.
Poggi. Yeah, I should know that. I'm Italian. My last name used to be Lizio. I should know that. I thought it was Poggi. So, Michael, you and I are in the same mastermind group together. We've known each other for a little while here. And what you're doing, we're going to dive into what you're doing actually here, because I think that's got a bright future to it, and I really like where you're heading there. But before we do that, why don't you give us a little intro, what got you into real estate investing, what you did before, and how things moved forward.
Thank you, Paul. I appreciate having me on your show today. And so as a young man, I got a chance to go work for a builder who had me doing everything from construction to, hauling lumber and cement and everything else. And I got a chance to learn how to build a house from scratch, many of them. So when I finally became old enough to get a real job, I went to work downtown Chicago, and I got a job as a stockbroker. And I was basically dialing for dollars and learning from my clients what they invest in beside what they invest in with me. And my wealthiest clients invested in 95% of real estate, only 5% in the stock market. So if I would ask my wealthy clients with $10 million net worth, if I would ask them, why is it that you don't spend $1 million or $2 million to trade in the stock market instead of only 500,000 out of their 10 million? They would laugh and they would say, Michael, stocks and mutual funds and even gold and silver are gambling. There's no guarantee that they're going to go up. They can drop in half at any time. You can't rent them out if you want to. You can't sell them on terms and collect passive income. So it's definitely not the way to become super wealthy. And then I would ask them if they would like to open up an IRA at our brokerage firm. And they would tell me that they had a self-directed IRA at an administrator that allows them to buy real estate. And I was scratching my head because I had never heard of that before. And I was in my 20s at the time, so very green and naive. I only had one suit to wear, and I had to wear it every day. That's how poor I was when I first started. So I went into my boss's office and I said, hey, boss, what is a self-directed IRA? And why is it that my clients are telling me that they have a self-directed IRA with all kinds of real estate in it, like apartment buildings and new construction and land? And why is it that we don't talk about that here? Well, he got mad and he slammed the door and he said, sit down, Poggi. And he gave me a lecture and said, don't ever mention the word self-directed IRA in this office again or you're fired. And I couldn't believe it. I said, but why not? And he said, well, first of all, if any of your clients know they can use a self-directed IRA and buy real estate with it, they're probably going to transfer out of here and put money into real estate, and you're going to lose lots of clients. He said, don't ever bring it up again. And I said, but when am I supposed to tell someone when they ask me about a self-directed IRA? He said, you tell them that their IRA is self-directed at the brokerage firm, and they can pick from any stocks or mutual funds they would like. I just shook my head, and I knew right then and there that that's not the kind of environment I want to be in.
Right.
So I ended up buying a brokerage firm, and I was able to then teach stockbrokers ethically about what to say about a self-directed IRA and tell the truth. And my brokerage firm grew very rapidly, and I hired several hundred brokers downtown Chicago and trained them. Well, it turns out that my wealthy investors, which was many of them, kept showing me what they did in real estate. So they kept saying, Michael, come on, hang out with me. I'll take you to lunch. Or if you take me to lunch, I'll show you my apartment buildings. Or take me to lunch and I'll show you my fix and flips or my vacant land or my development projects. So I started spending a lot of time with my 10% of my clients, the wealthiest of all, the 10 millionaires, 20 millionaires, 100 millionaires. And they took me under their wing and showed me everything they were doing, which would explain why they only did very little in stocks and mutual funds and why they had so much in real estate. So I got a chance to drive around with them and look at land and how to make land cash flow and all that kind of stuff. So I ended up selling my brokerage firm for a substantial amount of money. and I ended up moving to Florida. That was almost 30 years ago. And I started to invest in fix and flips, which was very successful for me.
Hmm.
And I started to build new houses from scratch. So I've built over 40 homes, and I have invested in several hundred fix and flips over the years, and was able to buy many, many vacant lots, like over 4,000 quarter-acre buildable vacant lots, and benefit from both appreciating and then selling them on terms to make passive income and make them cash flow. So I started to give seminars about those topics because everyone kept asking me, Michael, could you please teach me how to make vacant lot cash flow? Because no one's ever heard of that. No one's ever heard of making land cash flow. There's no tenants on it. So I started to teach people how to sell land on terms and how to collect income every single month on auto pay, and how to do all of that tax-free using a self-directed Roth IRA. So I was actually teaching two things: real estate investing without the headaches of, tenants or toilets, and then how to make a piece of raw land cash flow tax-free.
Yeah.
So that became very popular. So I wrote books that are on Amazon and taught courses. And what's funny is that the people that would want to buy my courses, or that did buy my courses, said, Michael, I love this. This is great information, but I don't have time to do any of this. I have a job. I'm a dentist. I'm a veterinarian. I'm a teacher. Could you please do it for me? I'm like, sure, why not? I'm already doing it for myself. So I started to source out and find quarter-acre buildable vacant lots in fast-growing resort communities for investors and clients and builders, and we became quite substantial at a go-to company to find those for investment purposes. So now to this date, we still help hundreds of people a year to source and find vacant lots. So for example, if someone has an IRA at Schwab or Fidelity or Bank of America, and they want to now change their direction from investing in stocks and mutual funds to either all or some of their money into real estate, we help them like a financial planner of real estate, basically.
Right.
So we end up teaching them how to make their IRA self-directed, and then how to use it for vacant lots, and then they hire us to find the vacant lots in these resorts, and we do our job, and we place them into their accounts so they can go ahead and enjoy the benefits of owning something that appreciates fast and has very little, if no downside.
So they're buying the vacant lots there, and then you're potentially helping them down the road or fairly soon afterwards to build on that property and sell that.
Each person is different, Paul. As you can imagine, everyone's got a different goal in mind of whether they want to buy for appreciation or buy for cash flow. So in some cases, some investors will buy a lot from me for 10 grand or 12 grand, and they ask me to turn around and put it for sale on terms at 10% interest, so they have cash flow coming in. So we offer that service. But the majority of the people buy the lot just like they would hold a mutual fund, just like they would hold a bond or an annuity or even a stock portfolio for 10 or 20 or 30 years. And the reason why is that if you sell a lot on terms right now, you're going to make about 10 or 11% interest. And that's not bad compared to, most mutual funds and annuities and bonds. But if you hold a lot, in my case, most of my lots have gone up about 20% a year in appreciation. And that's because they were in resort community. There was construction going on. There was houses going up. There was permits getting pulled. And that created a demand for land where everybody started buying them up quickly and forced the lots up in value, where they averaged about 20% a year. So for example, in 5 years, if I got 100% return, that's basically 20% a year. So in other words, if I bought a lot of 10 and 5 years later it was at 20, which is normal, that gives me 20% a year. Whether it's 10% a year or 20 or even 30% a year, it still beats everything that I have ever owned. So it beats every mutual fund I've ever had, every stock portfolio I've ever had. Even the best blue chip stocks could not outperform vacant lots in fast growing resort community. So we have a very strict, narrow formula that we follow. And there's about 10 things that are my criteria that we stick to make sure that it's the right lot in the right place at the right time for the right price. So it has to be done exactly focused and narrow, so we don't jump around the country in various subdivisions all over the place. We stay in one area at a time for 3 to 5 years until we bought up all the best buildable lots over 3 to 5 years. And then once we've exhausted that subdivision, we pack up and we go somewhere else with the same criteria. Under 20 grand, must be a quarter acre, must be buildable, must have paved roads, have sewer and water, et cetera, et cetera. So those are our strict criteria. And all we do is we end up going into a new subdivision that we memorize and learn everything about it, so we know exactly how long does it take a house to sell? How long does it take a piece of land to sell? Are there any permits being pulled? Are there roads getting widened? Are there shopping centers going in? And all those details have to be researched first, which we do a very good job of that. We spend lots of money on research to find out the data that tells us we're in the right place at the right time.
Are you targeting Florida specifically, or are you doing this all over the country now?
No, as a matter of fact, we don't target Florida.
Okay.
Because none of it meets our criteria other than sunshine. So, for example, it's hard to find lots under 20 grand.
Yes.
It's hard to find lots that have trees on them, because most of the lots in Florida that I used to buy are grass, and that causes $70 every 2 weeks to mow the lawn, or otherwise you get fined from the city. So we only buy wooded lots. That's part of our criteria, is wooded lots. They also have to have lakes and golf courses inside the subdivision, so that limits to hardly any in Florida.
Yep.
And then they have to have low taxes, low cost of living, and low cost to build if I or someone else would like to build a house on the lot. My criteria does not fit into Florida at all. For example, a lot in Florida, the tax is around $350 a year. Where if I buy a lot like in South Carolina or Georgia or Arkansas or Texas, the taxes are like $70 a year instead of $350. Significant difference in carrying costs to hold real estate long term.
Yeah, no doubt about it. It makes a lot of sense. And you could really target certain specific markets and really look at areas that are growing. And that sounds like what you guys do. Your team targets areas where newer development is going on. They're starting to put in Walmarts. They're starting to put Home Depots, Lowe's, schools, and all these different things where there's going to be more and more population going in, and these things will go up in value. That makes a ton of sense. Makes a ton of sense. And then you sell them with owner financing, more or less. You hold the note.
Well, most of my clients buy them in cash. They have money.
They do, right?
But there are a number of people, maybe 10% of the investors that come through my door, that don't have enough money to buy one lot at 10 grand. So maybe they put 5 grand down, and I finance the rest over 5 or 7 years. Or some people that are like me, they will, instead of buying 5 lots in cash, they'll buy 10 lots on term, which is basically half down. So when they use me as a bank, they can now have me finance them, and they can control 10 lots instead of buying 5. And that's how I built my IRA rapidly, was buying lots on terms when I was a young man. So I would buy lots on terms and control the real estate rather than own it. And that gave me the ability to inherit all of the appreciation the whole time that I was making my monthly payments. So if I made monthly payments for 5 years, at the end of 5 years, I get the deed, and by that time the lot's doubled. And I didn't put up very much money in the first place. So I was able to control more real estate than I've ever dreamed of, more than I've ever been able to have the money for. And then at the end of the term, typically by that time, the lot was up double or more. And I was able to then turn around and resell it on terms again. So I bought it on terms and then sold it on terms and created the arbitrage every single time, and did it all in a Roth IRA, self-directed Roth IRA, tax-free.
That's brilliant. I love that philosophy. Buying on terms, so you're getting it, putting minimal amount down to pick up the property, get financing, and then you sell it on terms for a higher price down the road and collect that difference. That's nice arbitrage right there. That's a great way to do it. Love that. That's an awesome business model.
Thank you.
So what markets do you, what parts of the country do you hit the most? Are you hitting South Carolina? Are you hitting Texas more? Are you hitting Arkansas? Like what markets seem to be the best for you right now?
Well, we were very heavily invested many, many years ago into Texas, into something near Austin called Lago Vista. And in Lago Vista, we bought hundreds and hundreds and hundreds of vacant lots around 9 grand and 10 grand and 11 grand. 5 years later, those lots had doubled to 18 grand, 19 and 20. And we've sold hundreds of those lots on terms at 11% interest for another 7 to 8 years.
Mm-hmm.
And those lots made us a huge profit. But now, looking back, 15 years later, those lots are worth $65,000 each. So I learned a very valuable lesson that just because lots are up double or even triple, it doesn't mean it's time to sell them.
Right.
So now my philosophy as a very mature investor is to buy lots and hold them no matter how much they go up. So if I buy a lot at 10 and now it's worth 40, I'm not selling it because eventually it's going to be worth 80, 90, or 100 just from construction going on. After we got done with Lago Vista, Texas, we went into a couple of subdivisions in Arkansas, not far from Walmart's headquarters, and we were able to really make serious money. We were buying lots at $2,500 and then $3,500 and $5,000 and then $7,000 and $14,000 and then $18,000 and $20,000, and we made an absolute killing in there. So now we're in a similar subdivision, only 45 minutes away from that area in Arkansas, that has the same exact formula, meaning under 10% built out, quarter-acre buildable lots, paved roads with sewer and water, with lakes and golf courses and hiking trails, and close to Branson, Missouri, and close to Walmart's headquarters, and close to all of the other tourist destinations, surrounded by a lake that's 300 feet deep and 79 miles long. So it's a beautiful subdivision, and we're buying lots in there for around 9, 10, or 11 grand, all that area. And so every month, we're picking up 50 to 100 lots a month that are going to clients' accounts that have put an order in with us. So when someone puts an order in, they go on a waiting list, and when the lots come in, we show them the lots so they can see exactly what they're getting, and then we close the following day. Very simple.
Simple and then low cost. It's not like the cost of buying a home here where, you're going to spend $150,000, $250,000, $350,000. So you take out those high costs, getting a lower cost, a lot of times on terms. You're cutting out, hopefully not having to do any lawn or maintenance or anything on the property like that, which is really helpful, big time. So this model, I'm a big fan of this model, so I can see why you like this so much and why it's grown so much and why it's attractive to investors who don't want to worry about the tenants and toilets. I'd say it's probably the next best model, even potentially it's better because it's even easier than self-storage facilities, which are low maintenance for real estate investing as well, but they still have some maintenance. These literally have no maintenance. For you're talking about, you're literally just buying them and banking on them, letting letting it get built out to where there's more, and then lots are going up because there's less and less available, which makes total sense. So you're saying you're buying them when there's less than 10% sold, right, of these lots in these communities?
No, when there's less than 10% houses in a neighborhood. I'm sorry.
Yes,
So
that's right.
when it's less than 10% built out.
Build out.
If the subdivision was 80% built out, the lots would be 100 grand.
Yeah.
But only having less than 10% in there makes the land so cheap. Otherwise, I don't want to buy lots at 100 grand. So let me give you a scenario, Paul, that might make it easier to understand for everyone. I would rather buy 10 lots at 10 grand each than one lot at 100 grand.
Yeah.
And here's why. If I buy a lot at 100, to double my money, I got to sell it at 200.
Yep.
And there's not that many buyers at $200,000. Those are luxury buyers that are basically looking to build their dream home with their husband and wife team. Where if you're buying lots at 10 and you're selling them at 20, it's the same exact percentage gain. It's still 100% return.
Yeah.
But it's easier to sell lots at 20 grand.
Yeah.
Just like slices of a pizza. Again, it goes back to the old scenario where what makes the most money? Slices of a pizza or selling the whole pizza? It's the same scenario. Owning vacant lots, multiple vacant lots that are cheap. When you go to sell them and you double your money, there's way more, there's millions more potential buyers at 20, 30, or 40 grand than if I had to sell a lot at 200 or 300 or 400 grand.
Yeah, it's reducing risk big time. It's big time reduced.
Sure.
It's like if somebody who's in a luxury house is buying them and they're 800 to 15 or $1.5 million compared to your person who's buying houses for 100 to 150. Much easier and much more people can qualify for a $150,000 house than an $850,000 house or $1 million house. So it makes total sense what you're saying here. So people are investing with their self-directed IRAs here, or a lot of people are. Some people probably buy with just cash, I imagine, as well. What do you charge on that for the people to buy? Because you're locating this, you're really helping them with that. What is the cost for them to get in?
Well, hold that thought, Paul, because I want to give you a couple other thoughts.
Sure.
Number one is there's another reason why that we want to buy cheap lots instead of $100,000 lot. When it's the financing reason. When you go to sell a lot, if we were selling a lot at 200,000 that we bought for 100, we would need to find someone that's going to make a payment for $2,000 or $3,000 a month.
Yeah.
They would most likely default. There's the default rate goes up.
Mm-hmm.
But if you're collecting only $200 a month from a $20,000 lot, now your default rate goes way down because it's less expensive. So we learned that to keep a low default rate when you sell them on terms, it's better to sell cheap lots than it is to sell a very expensive lot. So that reduces the default rate, and your money comes in by automatic draft from their bank account into your IRA or their bank account into your LLC. You also asked me a question a minute ago about where is the money coming from that investors are using. So it's not just cash, and it's not just IRA. That's only part of it. It's also coming in from old 401k plans that we help to roll over. So if someone has an old 401k plan from where they used to work, we assist them in the whole process from beginning to end to roll it over.
Yeah.
If some people are going to use a 401k solo 401k plan, a self-directed solo 401k plan, where they can deposit $80,000 a year. The other thing is that some people will end up using a current 401k plan where they work and borrow money from that 401k plan. Let's say they have $50,000 in a 401k plan, they can borrow $25,000 from that and use that for vacant lots. So it's IRAs, it's 401k plans, old ones and current ones, LLCs that have stocks in them, so brokerage accounts, and cash.
Makes a lot of sense. Yeah, I didn't even think about the rollovers. You get a lot of money for people exiting companies from that 401k to a regular old self-directed IRA, like you said, or a solo K, I guess you can put it into. So lots of options there. Yeah, you're getting my brain spinning now. There's almost too many options, too many ways to fund these things. And so you might have somebody come in with, quite a few $100,000. They could buy 10, 15, 20 lots and come in here and really buy up a neighborhood or a good percentage of a neighborhood. So how many lots do you buy typically per month, you and your students?
It depends. Sometimes it's a slow month because everybody's on holiday like Christmas, and it's probably around 30 lots. But we've had months where it's been almost as much as 100 lots.
That's a lot. That's a lot of lots.
From live seminars and webinars, and also past customers that own lots that are now doubled. They come in and say, hey, I'd like to go into the new subdivision with you, and let me have 5 more. So we have a lot of repeat business. And then also builders will ask me to find lots for them because they're too busy to do all that work themselves. They just want to build. So I'm talking about small builders that do 3 or 4 houses a year. They'll come to us and say, Michael, could you please find me 3 lots? I want to build 3 houses. And we do all that outsourcing for them. And we only make a small percentage on that. So you asked me how much money do we make. On a $10,000 lot, our profit is very slim, but we do huge volume. So we have a whole team of people that handle everything from making the offers. We're making offers on off-market properties. So we're not buying off the MLS. We're basically making offers by the thousands. And these are people that are not listed for sale. So we don't have much competition compared to a lot that's on the MLS.
Yeah.
So we're buying all buildable lots. We're making lots of offers. And when the lots come in, they have to be inspected by my team. They have to drive down the street and walk the lot and take pictures for us. Front view, side view, Google Earth view, and then print all of the data about the lot, like how far it is from the lake, how far from the golf course, how far from hiking trail. All of that stuff is compiled and then passed on to the new investor to go into their IRA or their LLC.
Beautiful. And what is the typical hold time for your average investor? Is there, do you know what the amount of years is or months?
A lot of my investors are doing what I'm doing, and since that I don't need to sell my lots at a profit because I'm successful, I hold mine for my 2 young children. So I have 2 young children, 4 and 6, that will inherit my lots when I pass away. And I would rather give them a big portfolio of vacant lots than a portfolio of stocks and mutual funds or gold or silver or annuities or bonds. So in this case, every person that comes through my system has a different need. Some people want cash flow because they're not doing well. So they ask us to buy the lot for them and then sell it for them. In most cases, though, about 90% of our investors are buying whole, and the best time to sell it is when they need the money, not a moment sooner.
Yeah. Yeah, that makes sense.
That could be 70 years old, 80 years old, 90 years old, or, like I said, pass them on to their heir.
And who handles the paying for the annual taxes and all those things? That automatically come out of the IRA? Do you guys set that up?
Yeah, so if an IRA owns 10 lots or whatever it is, or 5 lots, it can be set up on auto pay for the monthly property owners association to keep up the roads and, dead animals and garbage, if there's any garbage. So to keep it looking like a fancy resort, so it's usually $40 something dollars, like $42 a month to keep up the lot. And then taxes on the lots that I go into are like only $70 a year. You can't get any cheaper than that. I mean, that's the lowest taxes I've ever found in any subdivision is $40 a year.
That is cheap. That is very inexpensive. Yeah, I guess your biggest expense is then your HOA fees for them taking care of the roads if it needs snow plowed or whatever, and maintenance and all that kind of stuff on it.
Yeah, they're called POA fees, which is Property Owners Association fee. Once they put a house up, then it goes to HOA.
Okay, that's right. That makes sense. Yep. So the POA fees are probably far cheaper than when there's a house on it.
Yeah. So yeah, POA fees are just for maintaining and common areas, maintaining snow removal, stuff like that, just normal stuff to maintain the subdivision.
So very inexpensive in comparison there. Yeah, this model has me very, very intrigued. And when you were talking about it, you did a presentation a little while ago on Family Mastermind. You caught my interest there. I talked with Jeremy Knopf, our mutual friend there, and I definitely wanted to get you on here to talk more about this. It's actually something I'm going to pass forward to our students on our educational program, and this will get posted there, as well as, of course, the regular old podcast and YouTube and all that kind of stuff. But this model is one of the most simple models, I think, out there. How long have you been doing this, Michael? Because you did fix and flips, you did, new builds from jump. How long have you been doing this model?
28 years now.
A long time.
Yes, sir.
So 28 years doing this. Do you still do flips at all, or do you stick to this model at this point?
Well, my investors that have extra money after they invest in vacant lots ask me what else can they do with their money that's left over. And I show them fix and flips or other things that I trust that I would do with my own money.
Perfect. So you still do multiple things, which is great.
Yeah, quite a few things in the fire. New construction, as a matter of fact, we're now getting bids to start building in the subdivisions that I buy those vacant lots in right now as well.
Yeah, that's where you can really score big, because now you're not just getting extra value from the lots, but now you're building in the house and you got something astronomically more valuable than before.
It's tough building so far from home, though.
Yeah.
So unless you have a good operator on the ground that lives there, it's tough for me to build in another state when I live in South Florida.
Agreed. And no, absolutely. I totally agree. I've been doing, I have a lot in Florida because it was a double lot. I just split the piece of land, and I'm going to put either a double wide or maybe a prefab home, or maybe build something on that. I have one in Wyoming I'm doing something similar with, where I bought these properties from banks, and they had multiple lots on them. They sold it as one big parcel, and all I did was redeed it with two different lots, sold the one, and now I own these other properties free and clear, which I'll just, like you said, either just sit on it and sell it later on down the road, or build something on it. So I'm
Remember,
kind of,
if you remember in the future, Paul, when you decide to sell any land,
Mhm.
always consider selling it on terms
yes.
because you still control the deed.
Yeah.
And so let's say it's a 7-year loan and they stop paying you after 2 years, you still keep all that money and you still own the lot.
Yes.
So it's very easy. There's no risk at all. It's completely zero risk. It's like an automobile loan. If you don't make your payment, they come and take your car because it isn't your car in the first place until you've paid it off.
Yeah. And you don't have to evict anybody because they're not living in a house. It's just land. So if you, you can either sell it on installment contract sale, or I'm sure depending on the state, some states don't allow that, or you just hold the mortgage and then you,
Yeah.
I guess, do the
Exactly.
foreclosure
Depending on
process.
the state, whatever's works good. If you have to, transfer the deed, then you got to do what you got to do.
Yeah. Now, I've been there, done